Hey, listeners, welcome back to the ValueHunt podcast. And today I'm really excited because I'm here with François Rochon. He's really a super investor, and I admire all his work at Giverny Capital. And I bet you'll have a lot of insights to capture from this conversation. So make sure to take notes and all the good stuff. So yeah, Francois, why don't you say a couple of words before we jump into the questions?
Well, thank you for inviting me. I started to invest in the stock market something like 31 years ago in 1993, so almost 32 years now. And I was very much influenced by all the books I read by Ben Graham or Philip Fisher, and of course Warren Buffett's. So his annual letter of Berkshire Hathaway, were really a big inspiration to me. So when I started to invest, I was really hoping to not necessarily achieve the kind of results he has attained, but to generate results better than the average. And by using his very simple approach of finding great companies when they're undervalued in the stock market and owning them through many years. And so far, it worked out. I have my shares of winners and losers, but in the end, the results have been satisfactory.
Yeah, sure. Actually, I'm 18 years old, so you started investing almost like two lifetimes of mine. So yeah, it's a lot of experience for sure. And I would like to take a step back because I'm actually taking mechanical engineering, and I do know that you took engineering too back in the day. So I'm really curious to know, how did you pivot to investing, and what were your motivations back then?
Yeah, you're right. I studied to be an engineer and I became an engineer. So I studied at the École Polytechnique in Montreal, an electrical engineer, and I really enjoyed it. So I loved science and mathematical and physics and everything that was in the engineering education. And but I had other interests, including the arts. And after I graduated from university, I went to Giverny in France, where Claude Monet had his garden, and I really enjoyed the place. I thought it was a fantastic setting with water lilies and flowers and beautiful gardens. And I said, well, I'd love to build something like that in Montreal or in the area of Montreal. And I quickly realized I would need to get rich to build a large estate with ideally a collection of art. So I enjoyed engineering, but quickly realized that probably to get richer, I would need to find ways to invest and to increase my capital. So I started to invest, and I really enjoyed not only the results but the process of finding great companies. And after a few years of having this double life of engineering during the day and investor during the evenings, I left the engineering profession and went into money management. So that was in 1996. So I had been investing for 3 or 4 years. And I quickly realized when I started to work in the industry that most institutional investors are short term oriented. It's not necessarily their fault. There's a lot of pressure from clients. And I decided at some point that if I wanted to really invest the way I thought was the right way to invest with a very long term horizon, probably the best thing was to start my own company. And that's why I started Giverny in 1998. And first, you understand where the name comes from. It comes from the dream of building a Giverny in Quebec. But also, I thought that there were many lessons that you can learn from studying gardeners. So they know which plants they can grow into their gardens depending on the climate. And I would say that probably the most important quality needed for a great garden is patience. It takes many, many, many years to have great trees and great flowers. So patience is, I think, the key to success. And I think it's the same thing in the stock market.
Yeah, like it's quite interesting because I was just talking about gardening with my dad before the interview, so big coincidence. But um, like one of the questions I have for you is to the point you were referring back to patience and all of that. I'm really curious to know what's your take on why really smart people fail at kind of achieving sustainable returns and like good returns over long periods of time, because it everything looks really simple in theory, but then you also have all these big institutions that fail to achieve that. So why do you believe that that happens?
Well, that's a very interesting question, and I think it's a complex issue. I'm not sure that most of them fail. It depends what their objectives are. If they want to beat the index, I think a lot of them do fail if that's the main objective. If the main objective is just to grow their capital at satisfactory rate and just be ahead of inflation, probably most managers are able to do that. But the fact that they want to beat an index, a benchmark, of course, it's just, a benchmark is an average performance of many group of companies. So if you just the random selection of managers, half of them should be able to beat the index and half of them should not be able to beat the index. But it's higher than 50-50. It's probably something like 80-85% do not beat the index. One reason is just the management fees. When you have I don't know, 1.5% management fees, while you start a little behind the index every year. So that's one reason, but that's not the only reason. I think one key thing that people tend to forget is that most money managers, at some point or the other, they will owe some level of cash, 5, 10, 15%, depending on where they are in their opinion of the economic cycle. And long term, cash yields inferior returns compared to the stock market. So by having, let's say, 10% in a asset that yield 2 or 3%, instead of being invested in stocks that should yield something like 8 to 10% over the long run, well, you start with a disadvantage because of that. And probably the third reason, there's a lot of pressure to beat the index from the clients. There's a lot of pressure of trying to predict where the stock market will be, where the economy will be, what would happen with interest rates. And I think it's a distraction for most money managers. And trying to predict those, what I believe are unpredictable things, it's not only a distraction, but I think it lowers the returns. So it's a combination of probably those three reasons that most managers don't beat the index. So it's not really a failure because they don't have the proper way of looking at the investment. It's because there's some things in the nature of trying to beat the index. Probably trying to beat the index on the short term. That's probably one of the main reasons that people underperform. Because when they keep 10% in cash, for instance, in some ways, they're not necessarily saying that, but in some ways, they're trying to predict the stock market in the short term. They're hoping or they're fearing a correction, so they want to have some dry powder when that happens. And I think that the stock market cannot be predicted, so it's an illusion that most managers have, that they think they can predict the stock market. So it's little things like that that I think create this large percentage of money managers that don't beat the index. But
Yeah.
so when I started, I realized that. So I said to myself, well, what can I do to prevent those things happening to me? So the first rule that I stated 32 years ago almost is that I won't try to predict the stock market. I won't try to predict if there will be a recession, what will happen to interest rates, because these are things that will reduce my returns over the long term. And I will always be 100% invested in the stock market, not trying to predict the stock market. And I've been very faithful to that approach, and I think it has helped me over the years.
That's really interesting because I was thinking when you just started, when you were juggling between your engineering job and also investing, um, it must have been hard to find enough ideas or the time to kind of research those ideas deeply, because I find myself in the position where I basically have a full-time job, which is studying, and then I don't have as much time as I would like to look into several ideas that I have in investing, and that makes me kind of keep some cash because I haven't found the time to research those ideas and put the cash to work. So I'm curious to know, how did you kind of juggle between your job and investing and doing research back when you started kind of doing investing work?
Well, when I started, and it's still like that today, I never saw investing or reading annual reports or looking at securities at work as work. So to me, that was a when I began investing, it was a hobby, really.
Mm.
So like any hobby, you choose something that you enjoy, and when you do it, it's not work. So you can do it, until 11 o'clock at night, and you're not tired because you're enjoying it. So I didn't count my hours. So, and when I started, I was 24, 25 years old. So had lots of energy, lots of time. I didn't go out to restaurants or, plays or anything like that. I spent all evenings reading annual reports and looking at companies, and weekends too. And I remember that Sunday I would go to the library of the business school in Montreal because they have all the value lines, not only the recent ones, but I think it went back to 1965 or something like that. And you could read Forbes and Fortune and all the newspapers. So I would spend my afternoon just reading magazines and annual reports and articles, and I enjoyed it. So it was not work. So the fact that I had a full time job in those days didn't prevent me from spending a lot of time looking at the investment world. And it was a little different back in 93, 94, because there was so many opportunities in 93, 94 that, it was easy to go through Value Line and you could find 10 ideas every week that looked interesting. There were great companies that were trading at less than 10 times earnings in those years. So I was very lucky to start at a period that there were many opportunities. So so I had the time and there were opportunities. So made most of it.
Yeah, makes sense. Makes sense. Yeah, just like you, I also kind of do investing at all times when I'm in the bus or something like that. But yeah, probably I'll just be patient and wait for the right ideas to come at me. And one of the questions I would like to ask you is, how has your investing changed since you kind of have built a team around you at Giverny? Because I feel like investing is kind of a single player game, but obviously as capital grows, you need more resources to look at the ideas, and obviously you have somewhat diversified portfolio, 25 names or anything like that. So how has your style changed accordingly to those new circumstances, and have you felt any difference really?
It has not really changed. I would say that in the first years, I remember I read many, many interviews of great money managers. I remember there was a publication, I don't think it exists anymore, but it was called Outstanding Investor Digest. So I think it was published something like once a month, and they would interview money managers, and it was very thorough. I think it was something like 25, 30 pages. So this money manager would recommend stocks and explain why he likes, I don't know, Freddie Mac or Intel or Microsoft. It was very interesting. And you could find lots of interesting ideas in those publications. So there's other publication today that are similar. But what I like working with David in New York or François Campo in Montreal and JP in Montreal is that they'll explain what they like, what they read, and why they want to purchase the securities and why they think a stock is very interesting. And when I read what they write, it reminds me when I read Outstanding Investor Digest. And sometimes I agree, and sometimes, of course, I have my own stocks that I follow, but sometimes, they'll bring an interesting idea. I'll look into it, read the annual report, a little bit like I did 30 years ago when I was alone. And if I think it's interesting, I'll purchase it for my portfolio. And how we work at Giverny is that my portfolio serves as a model for everyone. So when I purchase something from my own portfolio, we'll purchase for all the clients. So that's basically how it's working. And the great thing is I'm much closer to the people I work with than I was when I read the Outstanding Investor Digest. So I have additional question or I want to understand something better, I just call them up and they explain to me why they like a certain security, and I can add some other question I'd like them to explore. So they'll talk to management and talk to analysts. So I think it's very useful. But basically, it's still the same work of reading about companies that it was 30 years ago. And of course, the fact that I have good colleagues, I think it has broadened the horizon of there's many companies probably I would never have heard of without them. So the more companies you look at, and Peter Lynch once said that to find many pearls, you have to open a lot of oysters. So the more companies you look at, the higher the chances of finding an interesting investment. So I think to have those great colleagues really broaden the investment horizon and has increased the number of possibilities of investments. And so it's been good, I think. But basically, the approach is very similar to what it was 30 years ago. I don't think the fundamentals, the principles of the stock selection has really changed in the last 30 years. I'm still very much influenced by what I read from Ben Graham, Phil Fisher, Warren Buffett, and Peter Lynch, as I did 30 years ago. I would say that probably I like to think that my process has been improved with experience. And but the general way of looking at securities has not really changed.
That's really interesting because I thought it was much more. It was like a different setup where the analysts would also kind of make decisions. So I feel like that's pretty much what we were doing back in the day, reading Investor Digest or the publication you were reading back then, but just for you, and it's not public. So I guess that's even better. To the point of working with really good people and smart and intelligent people. I would like to ask you, how did you kind of pick and found those high quality people to work with? Because that may also be useful when it comes to assessing the integrity and the quality of management teams, speaking about businesses. So what's your general strategy, or what are you looking for when kind of recruiting someone for your team or looking at management?
Well, I think it's different qualities, of course, being a CEO of a company and being a money management. But the first quality I look for is integrity. So I think I want honest people, people that acts like stewards. Either when you manage money or you're the president of a company, you're really a steward of other people's capital. So I think you have to have high level of integrity. I remember many years ago, there was a CEO of a company. I don't remember his name, but he said that integrity was like oxygen. When you don't have that, the rest is without importance at all. So that's the first thing I look at, integrity. And then afterward, I'll try to see if they have a independent mind, so they can think for themselves, not just repeating what they've read. And I think all the people that work in the team, JP, François Campo, John, David, Patrick, they all have the right behavior, they have the right attitude, and they think very independently. And I would say that I admire their qualities. I wouldn't work with people I don't admire. And I think very highly of them. And I've known some of them for many, many years. And I've always admire how they think. I think they all have the right behavior, the right patience level, the right qualities. We don't necessarily agree on everything, on all the securities, but there's nothing they buy that it wouldn't be a purchase candidate, because I generally agree with everything they're interested in. It's just at the end of the day, you have 100 candidates and you choose 20, 25 of the portfolio. Doesn't mean that the next 50 are not good. It's just that everything is relative. So I try to choose relatively to all the ideas we're looking at, the ones that are the most interesting. But I would say in one sentence, either the CEO of companies we invest in or the money managers I work with, I first and foremost admire them.
Yeah, I think that's a great filter to apply. Probably that's also what I will try to do when it comes to getting a job or anything like that. So I think that's great advice. One question I always ask is like, how do you get in touch with management teams? I know that now you have kind of a reputation and you've built a name in the industry, so it might be easier. But back in the day, do you used to get in touch with management teams, and how did you approach them?
Well, it's not that complicated. I would say that most management team, they're excited to talk about their companies, and if you want to go and visit them, they'll be happy to host you in their plants or their offices or whatever. Um, it's very rare that investors go visit companies. So when you do, they're very happy and open, and they love to talk about their companies. I mean, their companies is usually their number one passion. So it's not complicated to get to talk to management. So of course there's a little compliance thing. So there's quite periods of thing of that, and they can't reveal something that is not public, of course. But that's not what really we want to learn when we talk to them. We really want to learn what's their views of the industry, what's their long-term plan, what kind of culture they're trying to build within the company. So these kind of things they enjoy sharing.
Nice. Yeah. And speaking about reaching out to people, I love the story of you reaching out to Warren Buffett or like Berkshire to get the whole package of annual letters. So I'm really curious to know who your mentors are, because I bet there are a lot of people that look up to you. So it would be interesting to know who are your mentors, and if you could share any interesting stories about either meeting them or anything you would like to share about your mentors.
Yeah, of course. The first my first hero was and still is Warren Buffett. Of course, he's the greatest of all, and I mean he's the Mozart of investing. So he's to investing what Gretzky was to hockey. So he's the greatest of all time. So of course, there's many things you can learn, and he's very generous in teaching investors, not just by all the annual letters of Berkshire, but all the interviews he did on TV that probably you can find on YouTube, all the annual meetings of Berkshire that probably you can also see on YouTube. So there's hundreds of hours of education that is available. So he's been a hero to me, but he probably is to many other people. He has influence. Probably say the same thing, probably to a lesser degree, about Charlie Munger. lots of interviews, lots of writings, lots of great lessons that he has taught over the years. And there's many other authors. I mentioned Peter Lynch and Ben Graham, and John Templeton. There were a few other. Philip Fisher was really a big influence too. So I read his three books. I think was probably 95, 96 in those years. And I called him up. I think it was in '98. So I talked to him over the phone, not very long, perhaps 10 minutes, but it was a very memorable conversation. I do remember that one issue I had. I asked him. I think it was Hewlett Packard and Motorola in those days, and they were companies he invested many decades ago, but now they were much larger companies. And I asked him at some point, when those companies get very large, isn't it harder for those companies to grow? And he answered, I remember very clearly, it's not a question of size, it's a question of quality of management. So I think it was
Yeah.
a very important lesson to me. So there's many companies I invested afterward that looked a little big, and I thought it's going to be hard to grow, but they had fantastic management, and they were able to continue to grow at very high rates. So that was a very important conversation. That happened sometime 26 years ago. So, but I still remember it very clearly. So that
That's a really interesting
literature was
story.
a big influence, and there were some others. I mean, I think very highly of Glenn Greenberg, and of course David Poppy before joining us with the New York office. I thought very highly of him. I was a big fan of going to the Sequoia meeting and ask questions. I had a coffee with David, and we would talk about common interest in securities. And he's a very great, not only a great investor, but a great human being. I really admire him a lot.
Nice. That's interesting. Have you took any lessons from Sequoia? Like since they are investing in different kind of businesses, venture capital, and so on. Could you share any
Yeah,
insights
it's not
from
the
that?
same Sequoia as the
Oh,
private.
okay.
Yeah, it's yeah fun. It's based in New York, and it has a similar approach. It has changed a little bit over the years, but back in those days, early 2000, I would go to the annual meeting, and it was still Bill Riane that
Mm.
managed the fund, and Bill was a fantastic investor, fantastic human being. Very sadly, he passed. I don't remember what age. It was probably in the 70s, but that was such a great luck to meet with him. I think I met him twice, and yeah, he was a great investor, a great person too.
That's amazing. Sorry for the mistake, but
Yeah, no problem.
interesting insight, anyways. And uh, one thing that I always try to learn when I speak with great investors is really the behavioral component of investing, because I feel like the technical side of things can always be learned and can be taught quite easily in books or whatever, but the emotional side, it's harder to learn, and I guess you have to experience it for yourself. So I'm curious to know what are the general strategies, or what approach do you use to kind of keep your emotions steady when the market or the things are not going your way, and how you stick to your approach even though you have a lot of emotions, I guess, as everyone does.
Yeah, you're right that behavior is very important. I would say that, in my opinion, the money managers that do end up beating the index for many years have the right behavior. And
Mm,
in my opinion, the three right qualities that are needed is rationality, humility, and patience. And well, rationality is just to be rational about investing, not be affected by emotional things. And humility is, like I said, recognizing that you cannot predict the stock market, and also to know that you cannot understand every companies. You cannot understand every kind of assets. I mean, There's lots of things I don't really understand or cannot value, and I just stay away from them. One obvious example would be Bitcoin. I don't think it can be valued. So, and just stay away from it. I mean, I don't mind. I mean, I cannot value cocoa beans also, and I cannot value what would be the right price for copper or steel. So there's nothing wrong with that, but I just stay away from it. But humility is needed when you want to stay away from things, particularly when it's popular and going up every day. So you have to stay humble in those periods. And patience, I think, is probably one of the greatest qualities needed because it needs a lot of time when you invest in securities to be rewarded. Sometimes you're rewarded in 6 months, but sometimes it can take 6 years. So you don't know how long it's going to take for you to be rewarded. So patience is a very important quality. And I'm not 100% sure that those quality can be taught or learned. I think you
Mhm.
either have them or you don't. And I think most people, and it's just the way their DNA is programmed. I wrote that in one annual letter. It said that one key ingredient to be able to think differently and beat the index over the long term is to have what I call the missing gene. So I think a human being that is properly built in its DNA have what I call the tribal gene, and it's something that is passed on for many generations over the thousands of years. And it's just human nature. Then when you see the tribe running one way, is just to follow the tribe, and there's probably good reasons for that. That this gene exists. I mean, probably 5,000 years ago, if there was a people running one side in the village, there was probably a tiger coming in. So it was a good thing just to follow the crowd and ask questions later. But when you apply that 5,000 years later in the stock market, when people run, there's not necessarily a tiger. They're just fearful of something. And fear is very contagious. So if you're able to not go right when everyone is going and to be able to go left and do the opposite of what everyone is doing, not necessarily because you want to do the opposite, because you believe it's the right thing to do, well, that's a big advantage. And my theory is that probably 5% of the population, for some reason, don't have that gene. It's a missing gene. They don't have it. So they don't have the urge to follow the tribe. And for those, they can go left when everyone's going right. And they're the ones I believe that become not only great investors, but the great artists, the great thinkers, the great scientists, because they are able to create new things and go in new path that did not exist before. So for the other 95% of the population that have that gene, you know, they're just normal human beings. It's very hard for them to not to run right when everyone is running right, and even they try very hard and try to learn. I think it's the urge is very strong. So for them, I think it's very hard to beat the index. So I'm not to answer properly, and that's just an opinion. There's no scientific basis for that, but just from watching the world over 30 or some odd years, that's my theory that it's not a question of something that can be learned. The right behavior, I think, you have it or you don't, and there's not much thing you can do. You can probably improve a little bit on the patience, but it's very hard to urge to fight the urge of the tribe.
Yeah, I think that's a fascinating concept, and I had heard it before in past interviews, and I feel like it's quite accurate. And speaking about scientific basis, I would like to ask you if you feel like your engineering background has given you any advantage, if at all, in investing, and if you feel like like an engineering mind is useful in investing.
Well, it is, I think, useful, but probably in a strange, ironic way. Um, personally, I think most engineers at least, have some good understanding of mathematics, of probabilities, of how the world really works in practical life. And when you read about what analysts learn, let's say in the finance classes about efficiency in the markets and all the Greek letters they use, like alpha and beta and thing of that. I think they don't really understand mathematics and probabilities. It looks scientific, it looks intelligent, but I don't think it's a proper reflection of the real world. And I think being an engineer, I can see this. As some of my friends that are CFAs, I think they're missing something. They're missing some realistic ways of looking at the world of finance, and their views, the mathematical views on probabilities, returns, and things like that are not right. And it's very hard when you've been taught a way of looking at the investment world at university, or when you do the exams at the CFA. It's very hard to to say, well, that's very nice, that's very useful to get my diploma, but at the end of the day, it's not really useful in the real life. So I just forget about everything. It's very hard for them to forget about all that. And I think not having studied finance, well, I started it by being self-taught, by reading books.
Mm.
And I was lucky very early. Warren Buffett said to forget about all those Greek letters and the efficiency market theory. So I was not influenced by that. So I believe I stayed more realistic. And I'm always fascinating when I read analyst reports and they try to predict 5 years in advance what kind of earnings per share the company will earn, to two decimals. And, when they say it's $5.25 they predict, I always say, well, plus or minus $2. So it's the 25 cents is very ridiculous
Yeah.
because it doesn't mean anything. It's the odds of being off by 20% are so high that when you put two numbers, two decimal numbers, doesn't make sense. I see this because I'm an engineer, I believe. I think people in finance are too rigid with those numbers and don't see there's so many uncertainties. Not sure I have the right word in English, but there's so many things that are unknown that you cannot be precise. And I always say that in finance, precision is illusion. And I remember many years ago, I read a very interesting article about Ben Graham. I think it was in I don't know exactly, probably 1955 or 56. There was a hearing about the stock market, and they asked about how Ben Graham valued the company. And he answered, well, it's not very precise, but I usually come up with a range. And he said, well, let's say a company I believe is worth $50 to $70. And the judge said, well, it's not very precise. And Ben Graham said, it's not precise, but it's useful if the stock trades at $30 or $90. And I thought that was a very, very interesting sentence. And I don't think many people in the finance world learn about that story, because if they did, I think they will look at securities in all sorts of different ways.
Yeah, and then the teacher wouldn't have anything to teach, so I guess it would be a pity. And speaking about looking at reality and what the truth is, I've been delving for the last years on this concept called owner's earnings, presented by Warren Buffett in his annual letters. And I feel like there's always some kind of art in figuring out the normalized earnings or the true earnings of a business. So this is more of a technical question, but could you guide us through how you think about that, especially the maintenance capex part? Do you really try to figure out what that is for your businesses, or you come up with a rule of thumb like depreciation and amortization? So how do you think about that?
Yeah, every company I follow, I look through the accounting and I come up sometimes with very similar earnings. So let's call them the owner's earnings. And, you know, when Warren Buffett used that term, I think it was really a way to explain that they own shares of Coca-Cola or American Express. And for Berkshire, they just got the dividend in terms of the income statement and said, well,
Hmm.
we don't recognize the earnings of Coke, but we since we own, let's say, 6% of Coke, well, we should get in our income statement 6% of the earnings.
Yeah.
And so you would calculate all the earnings of the portfolio by using that approach, and would come up, let's say, I don't know, $1 billion of earnings should come from the companies we own shares in, and they are not reflected in the income statement. So that's because of the nature of the uh, Berkshire as a corporation owning a group of securities in the portfolio. At Giverny, it's of course very different. What we try to do with the owner's earnings, it's similar, but it's a different objective. What we try to compare is the performance of the stock market of our companies in one year compared to what we believe is the growth in the owner's earnings. So by owning shares of Amatec or Constellation Software or Berkshire or NDR or Visa, we try to calculate what is the earnings generated by the portfolio. And we calculate for every year and then compare one year to the other. So let's say in 2024, all the earnings of our companies combined has increased 10% compared with 2023. Well, if their stocks have done less than 10%, we know that probably our stock portfolio is a little undervalued because there wasn't a big reflection uh, by the stock market. But if they're up 20%, our portfolio is up 20%, we know that probably either our stocks have uh, reflected a previous undervaluation, or the other way is that it's a little advanced compared with the performance of the company. It's one or the other. So by focusing on what's happening to the companies themselves in the portfolio, we we're not as focused on the performance of the stocks themselves. We focus on what's happening to the companies. And I think that's the main objective of using those owner earnings. And I think the table in the annual letters that I think goes back to 1996, it reflects the performance of the companies we have owned over the years. And I don't remember the exact numbers, but I think the companies we have owned have grown their earnings by a little more than 12% a year. And the market performance of our portfolio since 96 has been a little higher than 12% a year. So there's been an incredible correlation between those two. But, over a year or two, there's probably no correlation. But over 20, 25, even 30 years, there's lots of correlation. So that's one part. So the second part is what do you calculate is the kind of real earnings. And I think it's harder today than it has ever been because analysts and companies use those non-GAAP adjusted earnings a lot. And so you have to do your own calculation of what you believe is the right earnings. And there's a little bit of judgment in that. And I think what is really needed is to be conservative because those earnings are not all conservative, especially when they exclude the stock options, the stock options that are given to either employees or management, it dilutes the earnings of the company, of course, but it dilutes probably in the future because the shares will be issued in the future, and they exclude the cost of those options from earnings, and I think that's a big mistake. Of course, these are not cash expenses because it's just options that are issued, but it will dilute in the end the earnings, and so you have to do a. I think you should exclude the share-based compensation from the earnings. So sadly, a lot of companies exclude them in their earnings release. They will give you the two. They will give you the gap and the non-gap. But most of analysts and probably a lot of investors too focus on the non-gap. And sometimes it's right, but a lot of times I think the earnings are overstated. So you have to be very prudent and very conservative. And sometimes a stock that looks like it trades at 15 times earnings, when you expense all the stock options, suddenly the PE expenses to 25 times. So it's not as attractive as they thought it was. So, and we'll look at depreciation. We'll look at the intangible amortization. To us, when they acquire another company and it creates intangibles and they amortize it over 15, 20 years, to us, it's not a real expense. So that will add it to the earnings. But we'll be very careful, when they amortize software that were capitalized before. So if they keep capitalizing software, well, you have to be very prudent. So you have to exclude the amortization, but you want to add back the capitalized software, and usually one is similar to the other. So, we used to be very careful at looking at the income statement very carefully, but I think today you have to also look very carefully to the cash flow statement. And I like it when companies expenses a lot of things, and so the earnings you get are very conservative. And probably I would quote again Ben Graham. That's he used to say that the three key words in investing is margin of safety. Probably he focused when he said that he was focusing on valuation in the stock market, but that margin of safety can be applied also to accounting. So you want to do your own accounting of the company and to be sure that when you come up with an earning figure, you've got a good margin of safety. It's on the low side of the reality. And yeah, I had a good investor friend that used to say that earnings is an opinion and cash flow is reality. So I'm not sure it's that clear, the difference, but you have to be careful in looking at both very thoroughly.
Yeah, for sure. It's funny because I was just looking at the company before our interview, and I saw they reported adjusted EBITDA, and it all made sense until I got to the stock compensation. So basically, I just deducted all the stock compensation from that adjusted figure because, as you said, it makes no sense to exclude that from earnings. So yeah, thank you for sharing your approach. It was really valuable. um, and now I would like to ask you, since I I feel like you have a pretty good experience with money, and you kind of have dealt your whole life with managing money and so on. I would like to ask you, what is the utility of money for you, and what does it buy and what does it not buy for you?
That's a very philosophical question. Well, Warren Buffett has always said that all the money he'll make in his lifetime is going to be given to charity. So, you know, he probably has everything he wants in life. And I would say that what I like, there's two things I see with money. Of course, one big important thing is, and that was important to me very young, I wanted to be independent. I wanted to be able to do what I think is the right thing with my time. I wanted to read and study things that interested me. And to be able to do that, you have to be free. I mean, you have to be able to have your house, your car, to eat, and so to travel if you want to. So I think the first step was to be independent. And so I got there some years ago. And then the extra was, like I said at the beginning of the interview, I want to build a museum. So I like to buy
Hmm.
art. I like to have plans for building a museum. I already started a little bit by opening a first pavilion this summer. And my long-term goal is to build a private museum with the proceed from uh, the business of Giverny Capital and the proceed from my own investment. Um, so, but it's a really personal choice. I mean, I'm not saying that my objectives are better than some other people's. It's just
Hmm.
it fits with what I like about life. I like going to museum. I like to build something, and I think it's very exciting when you have built a collection and a museum and you share it with the public and you see that people enjoying, and even if people did not enjoy it, uh, it's just the personal pride of having building something that I believe is beautiful. But that's me. I have some other friends that have lots of money and they want to do something completely different with it. So, and I respect that. So I don't have a general answer on what's the right usefulness of money. I would say it
Hmm.
depends on everyone. But probably to me, the first real thing important with money was to be independent. And once I reached that level, the rest is just to use it in what I believe is the most useful way. And I know that I will die at some point in the future. I won't be able to bring the money with me to whatever it is afterward. So every day, try to see what can I build with the proceed of my work, and that's what I chose. But different people could choose many different things.
Yeah, for sure. I'm curious to know what makes you happy about going to museums and all, because I feel like art really dominates, or I wouldn't say dominate, but really influences your life. So, what is it that you like about it?
Well, and art is a very large universe, and I would say that companies building a company, starting a company from scratch, is an art form. And
Hmm.
to me, Steve Jobs was an artist. Bill Gates was an art, and well, he's an artist. He's still alive. He's still building things. Mark Zuckerberg at the Meta, Facebook, has done an incredible job in what 2 decades or something like that. And he's a
Hmm.
great artist to me. He built something that did not exist before. And to me, an
Yeah.
artist, that's what he does. He produced something that did not exist before, and it produced something that changed the whole humanity, the way we look at human achievements. And to me, that's great art. And it can be a painting, it can be a company, it can be a book, it can be a musical piece, but there's an act of creation. And why it makes me so happy, I would say that I'm proud that human beings were able to produce such fantastic and original things. And I think it's exciting to learn about those things and discover things that you didn't know exist before. So when I go to a museum, let's say in Berlin or in Prague or in Vienna, every time I go to a museum, I discover a new work of art I didn't know before. And everything, and that's probably what really excites me, is when I discover something new, something I didn't know about. And when I discover a new company, when I read about, recently I read the annual report of Birkenstock, a company I'd never heard of before. And it seems it's been around for 250 years, so it took me a while. But it came recently public, and I thought it was a very interesting company. We have not purchased it yet, but just reading the annual report was an exciting event. So discovering new things I didn't know about the day before. Either it's a brand new thing or it's something old that I didn't know about. Uh, to me, it's a very very good way to live. And to me, happiness is to go to sleep at night and being excited about something I discovered today, and
Mhm.
saying to myself, well, when I woke up this morning, who would have known that I would have discovered this company, this artist, this work of art? And I think it makes life very enjoyable.
Yeah, that actually resonates a lot with me. Whenever I have interesting conversations like this one, I feel like I won the day. So it's really good to kind of keep learning about new things and finding out about new things. So yeah, I feel like that's a great take. Um, yeah, so just to wrap up our wonderful conversation, I would like to ask you a question. I've been asking a lot to my guests, which is, what advice do you have for me? And I know that we don't know each other that well, but based on our conversation and yeah, whatever you want to advise, I would be happy to hear.
Well, of course, it depends on everyone. I can just say what has worked for me, what has makes me happy. Um, Whatever interests you, you should do that the most you can. Sometimes it is you have to earn a living. You have to do things that they're just needed to be done. But when you enjoy something, you should try to do it uh, most of the time. And if you can find a job that you really enjoy, that's really what you should do with your time. Um, you remember when I was young and I got interested in art, I started painting, and I always said that if you want to be a painter, you have to paint. So every day you should go to the studio and paint, and if nothing happens, doesn't really matter. You're there and you're doing what you're enjoying. If you like to invest in the stock market, I think the right thing is just reading annual reports, looking at the companies. To me, it's going to visit malls to discover new retailers, to go to restaurant chains that I didn't know, and to discover a very interesting concept. I remember the first time I went to Buffalo Wild Wings. It was probably 15 years ago, and I really enjoyed that restaurant, and we invested in the company. So I'm always trying to discover uh, new companies, to discover new ideas, and discover new artworks, new artists, and uh, for my advice would be to find what makes your life interesting and your listeners, and try to do most of it and spend the most time that you can doing what you enjoy learning. And to me, it's businesses and artworks, but for some other people, it can be something else. But have to find and explore what you really enjoy.
Nice. I think that's wonderful advice, and I guess we can wrap up here. with this question. And the only thing I would like to ask you is, where can people kind of check out your work if they don't know about you, and if they want to learn more about you, where can they go?
Yeah, they can just go on the website of Giverny Capital, so givernycapital.com.
Nice. Okay, so I'll link that
All the
on the
annual
screen.
letters are there, and you can read some interviews, and so you can read about what really has has interested me over all those years.
Perfect, amazing. So yeah, I highly recommend everyone to check out Francois's work, and yeah, hope to chat again in the future.
Thank you for inviting me.